AT&T's Cost of Capital by John DeFeria. How much interest-bearing short-term debt does AT&T have at the end of 2009? After reviewing the financial statements, the short-term debt came out to $7,361 million based on its maturing debt, which is 1 year or less. Finding the tax rate was off of the financial statements, and it came out to 35%. And you multiply the short-term debt by the tax rate, and it gives you 2,576.4 in millions. What portion of AT&T's capital structure did short-term debt, long-term debt, and stockholders' equity represent in 2009? Shown by the graph here, or the table shown, short-term debt came out to 2.74% of all total assets, long-term debt came out to 24.08%, and stockholders' equity came out to 38.07%. Give you a total of 64.89%. For the capital structure, the data reports that 38.07% of the company is equity, and the remainder, 61.93%, is the company's debt. Calculate the long-term debt to total long-term capital ratio and the common equity to total capital ratio. You take the long-term debt and equity and add those together, and you get 167,045, which is your base. You then divide it by the 64,720 to get your long-term debt to long-term capital ratio of 38.7%. The remainder, which is 102,325, divided by the total of 167,045, and it gives you a common equity to total capital ratio of 61.26%. AT&T wants to issue fixed-rate 10-year bonds. According to Bloomberg, 10-year Treasury bond as of 3/19 of 2013 is 2%. You take the 1.5% spread into account and add those together, and you get 3.5%. AT&T's relevant marginal tax rate to calculate the after-tax cost of short-term debt and long-term debt, which is the bonds that hypothetically we're going to issue. Using the tax rate given of 35% and the short-term debt we calculated earlier, 7,361, you multiply that by 0.35 and you get 2,576.4. For the long-term debt, we take the 3.5%, which we calculated on the previous slide, and multiply that times 1 minus the tax rate of 0.35, and we get for the long-term debt, it'll be 2.275% in all long-term issued debt. Now finally, we're getting to apply the capital asset pricing model, security market line, to estimate our K. The CAPM is risk-free rate plus the beta times the market risk premium, and the calculation shows that with 2.0% risk-free rate multiplied by the 0.487, which shows in the table to the left of our average from the three financials taken from those three sources, multiply that times the market risk premium given of 7%, we get 5.409%. The beta shows of 0.487 was the average of the three different online sources. Table to your right shows the security market line. So at 0, we have the 2.0%, and it's a gradual line of a slope of 0.487. Thank you, and have a great day, everybody.